Hello, let's talk about the general ledger and why accountants post general journals to the general ledger. Third step in the 9-step accounting cycle is to post the general journals or journal entries to the general ledger. What is the general ledger? The general ledger is the master file of all transactions in the accounting system. When you look at the company's general ledger, you will be able to go back many, many years and find all historical business transactions. The general journal is also often called the record of final entry, and the process of recording the journal entry into the general ledger is called posting. The process of posting is automated in most companies, but you need to understand what the system is doing and be able to test that everything functions as it should during system implementations. Typically, the accounting team is responsible for end-to-end system testing when system modifications are being implemented. So it may seem tedious, but this is what you need to know because you will likely be involved in system upgrades and testing. The process of posting a journal entry to the general ledger consists of these 5 steps. On the ledger form, you enter the date of the transaction, enter description of the entry if necessary. You enter the general journal page in the posting reference column, enter the debit in the debit column or the credit in the credit column, and then you compute the balance and enter it into the debit column, balance column, or the credit balance column. On the general journal, you enter the ledger account number in the posting reference column. Let's look at the first transaction for Eli's Consulting, where Trayton Eli deposited $100,000 into the company's business bank account. In the general journal, we recorded this business transaction by debiting cash and crediting Trayton Eli's capital for $100,000. The general journal records transactions in chronological order in which the transactions occur, but now we want to have a permanent record of the transaction by account. So our first step is to pull up the account cash and write the date of the transaction into the date column and enter a description if necessary. Our textbook does not list a description, but in my opinion, there should be a description. In the posting reference column, we'll write the page number on which the general journal was recorded and write the debit amount of $100,000 into the debit column. Next, we'll calculate the balance of the account. This was the first transaction for Eli's Consulting for this account. Therefore, there is no prior balance for the bank account, and we write the balance of $100,000 into the debit balance column. Our next step is to post the credit of our journal entry to the Trayton Eli capital account. We follow the same steps, enter the date, enter the description and the posting reference, and then the credit amount of $100,000 and write the amount of $100,000 into the credit balance column. Our last step is to enter the posting reference on the general journal, which is the account number of the account that the general journal was posted to. Let's look at the second transaction for Eli's Consulting, where Eli's Consulting Services issued check 1001 for $5,000 to purchase a computer and other equipment. In the general journal, we recorded this business transaction by debiting equipment and crediting cash for $5,000. Our first step is to pull up the account equipment and write the date of the transaction into the date column and enter a description. In the posting reference column, we'll write the page number on which the general journal was recorded and write the debit amount of $5,000 into the debit column. Next, we'll calculate the balance of the account. Our next step is to post the credit of our journal entry to the cash account. We follow the same steps, enter the date, enter the posting reference and then the credit amount of $5,000 and calculate the balance. Our last step is to enter the posting reference on the general journal, which is the account number of the account that the general journal was posted to. Once all of our 12 journal entries have been posted, we can look at Eli's Consulting General Ledger. We can quickly see what we record in each account, the date and amount, and the balance in the account. Our bank balance has 10 transactions, and the bank balance is $111,350. In the accounts receivable account number 111, we can see that we had credit sales of $11,000, but that currently clients owe Eli's Consulting $5,000. The account supply shows a balance of $1,500, and prepaid rent account 137 shows $8,000. In the general ledger, the balance sheet accounts appear first and are followed by the income statement accounts. The order is assets, liabilities, owner's equity, revenue, and expenses. This arrangement speeds up the preparation of the trial balance and the financial statements, and many companies follow this methodology. The account equipment shows $11,000 of equipment was purchased, and the accounts payable account shows Eli's Consulting owes vendors $3,500. The capital account shows $100,000 and the drawing account $5,000. The fees income general ledger account shows $47,000 in revenue, and Eli's Consulting had only two expense general ledger accounts: salaries expenses for $8,000 and utility expenses for $650. In our example, we only have a few columns in our general ledger accounts. The bigger the company, the more information is tracked in the general ledger. For instance, additional columns might be department, project, location, or legal entity if the company has multiple subsidiaries. Here's an example that is very similar to your homework for Chapter 4. Here we have selected transactions of the Zillow Consulting Services Company. The first transaction is the starting investment of Martin Zillow, who invested $76,800 in cash to start the firm. We first analyze the transaction by deciding what resources or obligations of the company changed. In this case, the business cash increased and the obligation to Martin Zillow increased as well. Now we need to classify cash and the obligation to Martin Zillow. Cash is an asset, and assets increase with debits. Therefore, we need to debit cash. The obligation to Martin Zillow is an obligation to the owner and is part of owner's equity, which increases with credits. Therefore, we need to credit Martin Zillow capital. Let's look at the next transaction. Zillow Consulting purchased office equipment on credit for $7,050. How do we know that the company purchased on credit? It states that the amount is payable in 30 days. So for this transaction, let's first understand what resources or obligations of the company change. The company now has more office equipment, and office equipment is considered an asset. Assets increase with debits. Therefore, we debit the equipment account. The company also has more obligations now. It owes $7,050 to Furniture Expo. We call that an accounts payable, which is an obligation or liability. Liabilities increase with credits, and therefore we need to record a credit to the accounts payable account. Let's look at the third transaction. Zillow Consulting purchased an automobile for $32,900. So for this transaction, let's understand what resources or obligations of the company change. The company now has an automobile, which is considered an asset. Assets increase with debits, and therefore we debit the automobile account. The company now has less cash. Cash is an asset, and assets increase with debits and decrease with credits. That means we have to credit cash. In this next transaction, Zillow Consulting purchased supplies for $855. The company now has more supplies, which are considered assets. Assets increase with debits. Therefore, we need to debit the supply account. The company now has less cash. Cash is an asset, and assets increase with debits and decrease with credits. That means we have to credit cash. On September 5th, Zillow Consulting returned damaged supplies for $215 for a cash refund. The company now has more cash. Cash is an asset, and assets increase with debits. That means we have to debit cash. The company now has less supplies, which are considered assets. Assets increase with debits and decrease with credits. That means we have to credit supplies. On September 6th, Zillow Consulting issued check 1003 for $4,050 to Furniture Expo. The company now has less obligations. We previously recorded the obligation as an accounts payable, and now that accounts payable decreased. Liabilities increase with credits and decrease with debits. That means we have to debit accounts payable. The company now has less cash. Cash is an asset, and assets decrease with credits. Therefore, we have to credit cash. On September 7th, Martin Zillow withdrew $6,900 for cash for personal expenses. The company now has less obligations to the owner of the business. And we previously recorded the obligation as owner's equity, and now owner's equity decreased. Owner's equity increases with credits and decreases with debits. And personal withdrawals are tracked in a separate account from the initial capital that Martin contributed. We use the drawing account to track those withdrawals and will debit the account for $6,900. The company now also has less cash. Cash is an asset, and assets decrease with credits. Therefore, we have to credit cash. On September 8th, the company issued check 1004 to pay the rent for September. The company now has less cash. Cash is an asset, and assets decrease with credits. Therefore, we have to credit cash. The company now has more resources since rent is considered prepaid expenses until fully used up. Prepaid rent is an asset, and assets increase with debits. It means we have to debit prepaid rent. On September 9th, the company performed services for $18,865 in cash. The company now has more cash. Cash is an asset, and assets increase with debits and decrease with credits. Therefore, we have to debit cash. The company also now has additional revenue. Revenue increases with credits, which means that we have to now credit fees income. On September 10th, the company paid the phone bill for $285, which decreased cash and results in a credit to cash, and it increased expenses which means we have to now debit telephone expenses. Each transaction is now entered as a journal entry. For instance, for the first journal entry, we write the date and then cash and a debit of $77,600. On the next line, we slightly indent and write Martin Zillow Capital and a credit of $77,600. We repeat the process for each transaction until all journal entries are complete. Our last step is now to post each journal entry to the general ledger. For instance, to post the first transaction, we go to the cash account, we enter the date, and we enter the debit of $76,200. Then we calculate the new balance. Next, we go to Martin Zillow Capital, and we enter the date, and then we enter the credit of $76,200 and calculate the new balance. To post the second transaction, we go to the equipment account, we enter the date, and then we enter the debit of $6,450. Then we calculate the new balance. Next, we'll go to the accounts payable account, and we enter the date, and then we enter the credit of $6,450 and calculate the new balance. That's it for this video. I hope this lecture and the example was helpful.